literally thousands of deals out there, and it's a business that's really stuffed with loads of off-putting jargon. So getting a mortgage, particularly for the first time, can feel like a really daunting and frightening thing. There are several things you need to do really before you even start. First of all, you need to think about how much do I need to borrow? How much can I borrow? And also, what sort of product is going to be the best for me? Now, mortgages have traditionally come in two types: repayment and interest only. Now with a repayment, it's fairly simple. What you pay each month pays off the interest and the loan itself, so that by the end of the whole period, 25 years or whatever it is, you should have completely cleared the debt. Now with an interest-only mortgage, you're only actually paying off the interest each month. And what you're supposed to do is set up like an investment, such as an ISA or something, to pay off the capital, the main debt, at the end of the period. Now the trouble is, not everyone does do that. Many banks and building societies have actually stopped selling interest-only mortgages because they view them as too risky. These days, probably for most people, particularly buying their first home, they're probably most likely to get hold of a repayment mortgage. There's an informative fact sheet about the differences on our website. Now, once you've established whether your mortgage is going to be repayment or interest only, you then have to make the major decision of what sort of rate you want to be on. Basically, there are three options. You could get a fixed rate mortgage, a tracker mortgage, or a discounted rate mortgage. Now, if you're a first-time buyer, or you're someone who really wants the certainty of sort of fixed monthly payments, you don't really want any nasty shocks, then you should probably really be going for a fixed rate mortgage. So your payment is set, you know where you are, and you can budget. With a tracker mortgage, you track usually the Bank of England base rate. And with a discounted rate mortgage, basically what you pay is related to what's known as the SVR, which is the standard variable rate that the bank or the building society has. And again, what you pay sort of goes up and down in relation to that. Some people will be confident making the decision themselves. They'll be able to choose what mortgage they want. They'll be able to ring up the provider, do it all themselves. Other people won't. They'll maybe want to see an advisor in their bank or their building society, or they may want to use a mortgage broker who can basically look at all the different deals that are on the market and sort of work out what's hopefully the best deal for them. One of the best places to look, aside from the Guardian Money website of course, is Money Facts, which provides constantly updated information on all the best buy mortgage deals. Now when you see a mortgage deal advertised, you'll see something there, and it's a horrible bit of jargon, called the loan to value, or LTV. Now this is the maximum amount that you can borrow under this loan from that bank or building society, shown as a percentage of the price of the property that you're buying. Sounds a bit of a mouthful, but in other words, a 90% LTV deal means that they will let you borrow up to 90% of the price of the property that you're buying. The bit that's left between the percentage and 100%, that's the deposit. So in simple terms, if it's a 95% mortgage, then you've got to find a 5% deposit. If it's a 60% loan to value mortgage, then you've got to find a 40% deposit. So this is very important because there's no point trying to apply for a 60% LTV mortgage if you've only got a few thousand quid set aside as a deposit. Now what most people are obviously going to want to know is how much can I borrow? Now as a very rough rule of thumb, if say you're earning £20,000 a year, you're probably roughly looking at being able to borrow between £65,000 and £80,000. If it's a couple who are both on £20,000 a year, then you could probably up that to maybe £100,000 to £110,000, maybe a little bit more than that. A lot of lenders are moving towards what's called affordability checks, where they sort of look much more at you as an individual and all your different outgoings and incomings and all that sort of thing. Looking at things like any debts that you've already got, what are your bills, council tax, all these other things, and they sort of put them all into the mix to sort of see how much they think they should lend you. Now if all this sounds a bit confusing, there are several easy to use mortgage calculators where you can put in your annual income and your partner's annual income if that's relevant, and it'll give you a ballpark figure for sort of how much you're likely to be able to borrow. Now don't forget about the fees that will probably be attached to the mortgage. Most mortgages come with a sort of a main lender's fee. It can go by different names. It might be the arrangement fee, the product fee, the booking fee. And the bad news is that these fees have been sort of creeping up in recent years. As a general rule of thumb, it's worth paying a larger fee for a low interest rate if you're taking out a big mortgage. Getting a mortgage these days is a lot tougher than it was 10 years ago. But the banks are lending billions of pounds to people taking out mortgages, and hundreds of thousands of people are getting mortgages, so there's no reason why you shouldn't be one of them.